So let us look at these two taxes which are highlighted in yellow. Income tax, when it is paid to the shareholders, it is called as income tax expense. Income tax expense. We have seen that earlier, and this tax is known as taxes payables. Taxes payable are those taxes which you're going to pay to the tax authorities. Okay, so when we talk about this equation where we had seen earlier that income tax expense is nothing but taxes payable plus your deferred tax liability or deferred tax assets. So DTL, deferred tax liability or deferred tax assets. So let us look at how this equation fits in for year 1. For year 1, this will be 120 is the income tax expense. This is equal to taxes payable is 80, as we can see here. So this plus your deferred tax liability, because you have paid less and you have shown more. So your DTL comes out to be 120. So this is year 1. What about year 2? In year 2, let us look at what are the respective income tax expense and taxes payable. That is 200, 400 here and 400 here. So essentially we're talking about 400 as income tax expense and taxes payable also as 400. So your DTL will be equal to 0. So DTL comes out to be 0. So what about year 3? Year 3, let's go back and see what happens in year 3. In year 3, we note that the taxes which we have shown is 600 in the shareholders reporting, and we have paid actually more, that is 660. So in this case the situation will reverse. Here we have 600, this is equal to 660 plus your some number. This number comes out to be minus 60. So what happens is this reverses your deferred tax liability. This reverses your deferred tax liability. This means you have paid more and you have shown less. So here you could see that there was 120 that was built up initially, then there was 0, and then out of this liability in this year 3 you pay 60. Okay, now let's take year 4. In year 4 we note that the tax which we have shown is 800 and we have paid more, that is 860. So again the same situation arises like what we have seen in year 3. This was 800, this is equal to 860 plus some number, and x this equals to minus 60. This means this will reverse your deferred tax liability. So let me show you how this will get recorded in each year when it is about the balance sheet. Okay, so let's look at year 1 balance sheet. Okay, this is asset and this is liability, and what we notice in year 1 we have the deferred tax liability that comes out to be 120. So we'll write here as DTL. This comes out to be 120. This is year 1. Now what about year 2? In year 2 what we notice that you have assets, you have liabilities. Now what happens? Initial liability is 120 and then there is no addition or subtraction of this liability. So here as well your deferred tax liability is 120 because there is no addition or deletion in the respective years. Now let's look at what happens in year 3. Assets and liabilities. Now in year 3 you have actually paid off 60 worth liability out of this 120. So what you will show on your balance sheet is your deferred tax liability will be 120 minus 60 which you have actually paid off. This means you have paid more than what it was shown in year 3. So this comes out to be 60 here. And let's look at year 4. Here again assets and liabilities. What will be your deferred tax liability shown here? Your deferred tax liability was 60 earlier, and you can see that in year 4 also we have paid 60 more. So this gets reduced and it goes back to 0. So what we have seen here is that a phenomena where it started with creation of deferred tax liability, it moved and remained constant, and then it started decreasing. Here we saw that this was decreasing and then it went back to 0. So whenever there is a liability which is formed of this sort, where it comes on the balance sheet only temporarily, this was only temporarily that the liability came. So it came and it got back to 0 over a period of time. This is known as temporary difference. Temporary difference. And this temporary difference is reversed over a period of time, like what we saw in these 4 years. Okay. Then there can be some differences which do not reverse. These are called as permanent differences. I'll come to what permanent differences would be looked at and how they are kind of taken on a balance sheet. But for the time being, please understand temporary differences goes back and reverses itself to 0.